The SVOL ETF is currently yielding 17.9%, which I'll admit sounds crazy, but those dividends have meant the difference between winning and losing. Here's the S&P 500 total return over the past year, down almost 8%. But if you held SVOL over the past year, you'd be up just over 6%. We're looking at SVOL today because it's done well recently. Over the last 12 months, for total returns, it hasn't just beat the S&P 500, but also some other high-income funds, including JEPI and XYLD. And I'll admit, 12 months is a short period of time for dividend investing, but SVOL has existed for less than 2 years, so we don't have much history to go on. Today, we'll look at how SVOL generates that massive yield, how sustainable the yield is, and some of the hidden risks of holding this fund. A quick disclaimer, I'm not a financial advisor, I'm just a retired investor sharing the research I do for my portfolio. I make these videos to help you decide which investments you want to research. Let's start with the fun part, the dividend. Technically, it's a variable dividend, but the fund managers have been keeping it at around 32 cents per month. And in case you're wondering, dividends are taxed as ordinary income. Now, before we take a look at how they generate this massive yield, let's take a look at why this fund exists in the first place. I think it's really important to understand a fund's objective before considering investing in it. If you read the SVOL Objective and found it a bit confusing, don't worry, I had the same reaction to it. So let me break it down for you. This objective is taken from the Simplify Asset Management website, and I'll put a link in the description to it. The Simplify Volatility Premium ETF, SVOL, seeks to provide investment results before fees and expenses. I'll pause here to let you know that fees and expenses are 0.66%. That's in the range of normal. Some people have said they think it's a little bit high. It is a very actively managed fund with annual turnover of over 200%, so I'm okay with it. So far, so good, so let's continue. Provide investment results before fees and expenses that correspond to approximately 1/5 to 3/10, negative 0.2x to negative 0.3x, the inverse of the performance of the SVOL Volatility Index, VIX Short-Term Futures Index. Yeesh, let's pause again. This is where it got more complicated, at least for me. SVOE stands for the Chicago Board Options Exchange, that's simple. The Volatility Index, also known as the VIX, is a measure of the expectation of volatility over the next 30 days. It's not a measure of current volatility. And the VIX is calculated based on the price of S&P 500 options. It's sometimes referred to as the fear index. And that's because when the market is fearful, there's more demand for options because they're used as a downside hedge. And as demand for options increases, so does the price of options. Okay, so the VIX measures expected volatility. What's this negative 0.2x business? The SVOL fund invests in futures to short the VIX. That means that instead of profiting when the VIX goes up, the SVOL fund profits when the VIX goes down. That's why you see the negative sign there and the word inverse. They mean the same thing. 1/5 and 0.2 are also the same thing. So I don't know why they repeated those numbers. Would have been easier just to say negative 20 to 30%. And those numbers are less than 100% because only a portion of the fund is exposed to shorting the VIX, roughly 25%. So in round numbers, if the VIX went up 100%, SVOL will go down 25%. Why would SVOL want to bet on the VIX going down? Because it's consistently profitable. The VIX usually goes up when the market is crashing, and investors will pay a high price to receive a payout when that crash occurs. And because SVOL is shorting the VIX, they're on the receiving end of that high price. Most of the time, the market isn't crashing and the VIX isn't spiking, so SVOL is collecting some juicy profits on their short VIX positions. You could think of it as insurance. Investors buy options and futures that are long on the VIX so that if the market crashes, they collect. Now, if the VIX does spike, then SVOL has a problem, which we'll get to shortly. But first, let's get back to the objective. While seeking to mitigate extreme volatility. This one's easy. SVOL pays out a fairly consistent and high dividend every month, and this has the effect of reducing volatility of its returns. Let's continue. We believe many traditional sources of income are failing to meet investor needs in today's low-yield environment. That's just marketing language. There are plenty of income investments available, and this is a new one to add to the list. SVOL aims to provide an attractive income stream. I think by attractive, they mean high consistent dividends, and so far they've delivered on that. Let's continue on with the objective. And source of diversification while seeking to avoid risks inherent in other income-producing asset classes. This one is often overlooked. SVOL isn't directly linked to a single business or sector or commodity. SVOL is mostly correlated to the S&P 500, but it's not a one-to-one correlation because SVOL has less volatility. So depending on the composition of your portfolio, SVOL could give you some diversification. Moving right along, the fund's short VIX position provides investors an optimized exposure for monetizing the premium in the VIX futures market. This is just saying that investors pay through the nose for hedges that protect them from periods of high volatility, and owning SVOL is a way to be on the receiving end of those high payments. And we're almost finished. Here's the last sentence. A modest option overlay budget is then deployed into VIX call options to help protect against adverse moves in VIX. Earlier I said that if volatility is low, then SVOL makes a profit. Well, if volatility is somewhat high, then SVOL doesn't make as much profit, or it could incur some losses. But if volatility goes crazy, I mean through the roof, which it has twice in the last 20 years, then obviously SVOL has a big problem, because those futures they invested in to short the VIX lose most of their value. So to cover against that potential loss, SVOL spends about 1% of its assets each year to buy insurance against that possibility. And that insurance is in the form of call options. They're written a long way out of the money, so they're fairly inexpensive, and they only pay out if there's a huge spike in the VIX futures. So now you know SVOL's objective. There is a lot to it, but if you break it down into those chunks, it does make sense. Let's move along to the bull case for SVOL, some reasons why I think this can make a compelling investment. This particular income strategy doesn't cap the upside, unlike the covered call ETFs. Therefore, if the market does go through a sustained period of low volatility, then this fund should perform quite well. One of the portfolio managers, Shailesh Gupta, said that the fund is aiming for a long-term average yield of 15% under normal market conditions. Currently, of course, the market is bearish, and so therefore the price of the fund is depressed, which makes the yield higher than normal.
I would say we are targeting around 15% or so. Could
Okay,
be a little
very high.
higher, could be a little lower, but around that ballpark, I think that should be the average over the next few years.
And if he's right, then SVOL doesn't really need to appreciate much in order to generate fantastic returns. If it can just sit in the low to mid 20s for a few years and spit out 15% dividends, then it makes for a pretty good investment. Second thing I like about SVOL is that the returns come in the form of dividends, which isn't a theoretical or a paper profit, it's spendable cash, and that provides a lot of flexibility. For example, you could reinvest those dividends, or you could use them to buy a different investment. You could mitigate SVOL's risk by taking those dividends and putting them into something like SCHD for growth or UTG for income. Most funds hold a basket of stocks and very little cash. But SVOL's strategy is based on trading derivatives that require using only a small portion of the cash in the fund, which means most of it is just sitting there, and they can use it to buy short-term treasuries, which generates, at this point in time, interest. And that's additional income on top of SVOL's VIX shorting strategy. Now, before we look at the bear case, a lot of the research for this video comes from Seeking Alpha. And if you're not familiar with it, I made a short video that explains some of the features that are useful for dividend investors. There's a link in the description for you to get a discount on your first year. I'll start the bear case with the obvious issue. SVOL began in May of 2021, so we don't know how it would do in a black swan event, or even how it would recover in a bull market. Secondly, SVOL relies on that option overlay strategy to save it if there's a black swan event. And frankly, there's no guarantee that this will definitely work. The summary prospectus specifically cites this risk. It says the advisor's overlay strategy will not fully protect the fund from declines in the market. During COVID, the VIX spiked 500%. So those call options would have kicked in and they would have generated a lot of income. The fund manager, Simplify, says that backtesting indicates that the option overlay strategy would have saved the day. And that may be true, but we don't know for sure how options and futures markets will react during a black swan event. As an alternative point of view, this Seeking Alpha article ran backtesting scenarios with different assumptions, and the results were losses of 20 to 60%. I'll put a link to that article in the description. If the market remains at elevated levels of volatility for a sustained period of time, that would eat into SVOL's net asset value, or NAV. Or to put it another way, if there's high volatility for the next year or two, it's likely to result in SVOL's price going down. SVOL invests in options, futures, and futures derivatives, not tradable assets. Therefore, the fund relies on options markets and futures markets operating as expected. And that leads to a long list of risks, too many to cover in this video, but they are outlined in the summary prospectus, and I encourage you to read it. Here's another sobering quote from that document. An investor in the fund can lose all or a substantial portion of his or her investment within a single day. The longer an investor's holding period in the fund, the greater the potential for loss. This is the most complicated fund I've ever researched. Even though I understand the basic concept of shorting volatility, it's difficult to understand all the moving parts of this fund. For example, you can't invest directly in the VIX. It's just an index. So in order for it to short the VIX, it has to invest in ETFs that are proxies for the VIX. And Simplify's website doesn't currently disclose which futures it's investing in. The list of holdings shows this symbol, but if you Google those letters, it's a dead end. If anyone knows what those letters mean, please put it in the comments below. I looked high and low, couldn't find it. And there's one last point on complexity that wasn't addressed in any of the YouTube SVOL reviews that I watched, and I watched a lot of them. For simplicity, most discussions of SVOL talk about shorting the VIX. I've used that phrase just to keep it simple. But if you read that objective that we looked at earlier in the video very carefully, SVOL doesn't short the VIX. It shorts the VIX Short-Term Futures Index. And they're similar, but they're not the same thing. The VIX Short-Term Futures Index shows the price movements of a basket of futures that are indexed to the VIX. Both indexes will trend in the same direction, but they're created with very different methodologies. And if you read those methodologies, you will fall asleep. But my point is to show the complexity of this fund. Let's take a quick look at pricing. You can't value SVOL the way you'd value a stock because there's no underlying business or assets. So how do you know when to buy it? What's high, what's low? Well, reading through some forums, a common strategy is to buy SVOL when volatility is high, because when volatility falls, SVOL will increase in value. So an example of this strategy would be to buy SVOL when the VIX is at a level around 30, and then sell it when VIX hits a level of around 20. And this is known as the mean reversion trade. And it's based on the theory that while volatility can go crazy, it always comes back to a normal level. And that strategy may work, but while you're sitting on the sidelines, you're not collecting any of that income, so I haven't tried it. SVOL is a high-risk, ultra-high income fund. I took a really small position, about 1% of my investable funds, because I think the reward is high enough to justify the risk for my personal risk tolerance. And I'll also admit, I think it's a new and original concept and an interesting experiment. This is definitely not an investment that you use to pay your mortgage or your rent, and I encourage potential investors to read through that summary prospectus, I'll put a link in the description, and to fully understand the risks involved. That wraps it up for SVOL. More armchair income coming soon. It doesn't disclose which futures